Today we're starting a new topic, student loans. More than 45 million people in the United States have outstanding student loans, owing a total of $1.75 trillion. That's such a big number that it was hard for me to really even imagine it. To put that number in perspective, if you spent $1 million every single day, it would take you 4,795 years to spend that much money. Put another way, if you had 1.75 trillion $1 bills in a stack, it would be 119,000 miles tall and reach halfway to the moon. Needless to say, the student loan crisis is a major issue facing our nation. There's so much to cover on this topic, I've decided to break it into a series of videos so you can more easily find the parts that are applicable to you. The first video will focus on the types of student loans available and the financial vocabulary you'll want to be familiar with to understand your student loans. Let's jump in. At the most basic level, a student loan is just like a car loan, a mortgage, or any other loan you might take out. The initial amount that you borrow is called the principal. Over the lifetime of the loan, the lender tracks the amount of principal that you haven't paid back yet. This is called the principal balance. You'll be expected to pay back all of the principal over time plus interest, which is a financial term for the fee you're paying to borrow the money. If you borrow $10,000 of principal at an annual interest rate of 7%, then you're agreeing to pay 7% of the principal balance as interest every year. Most loans charge a monthly interest rate, taking the annual interest rate and dividing by 12. So a 7% annual interest rate would be a 0.5833% monthly interest rate. Student loans actually charge a daily interest rate using the number of days since your last payment. I'm using monthly interest rate calculations in my examples throughout this video to keep the math simple. The process of adding interest charges to your bill every day until the entire principal has been repaid is referred to as accruing interest. In your loan paperwork, they'll always use the term accruing interest, but throughout this video, I may say adding new interest, charging interest, or various other less technical terms that mean the same thing. Loan duration is the time period in years that it will take you to pay off the principal and interest if all monthly payments are made exactly on schedule. If you make extra payments or larger payments, you'll pay off the loan sooner than this. If you miss payments, then it will take much longer. You're probably familiar with the concept of making fixed loan payments every month for years to pay off a loan. What you may not understand is the amount of that payment that's going towards interest and the amount that's paying down the principal. The answer is a little complicated because it changes every month. Let's build an amortization schedule, which is a fancy word for a table that shows all the monthly payments throughout the course of a loan. There are many loan calculators out there that will create an amortization schedule for you if you can provide the principal, interest rate, and loan duration, so no need to do it by hand. If you have a $10,000 loan at 7%, the monthly interest rate would be 0.5833%. Let's assume this is a 10-year loan duration, which is pretty standard for student loans. That means there will be 120 equal monthly payments of $116.11. Every month, you'll be charged interest on the current principal balance. So in month 1, you would owe $58.33 in interest. When the bank receives your $116.11 monthly payment, they'll put $58.33 toward interest, which leaves the remaining $57.78 for the principal. In month 2, your principal balance has been paid down to $9,942.22. So the 0.5833% monthly interest rate is multiplied with that number to calculate month 2 interest of $58. This time, the bank takes $58 out of your $116.11 monthly payment for interest. That leaves $58.11 for the principal. If you continue this calculation for all future months, you'll quickly notice that your early loan payments are largely interest, while your later loan payments are mostly principal. If we compare the first month with the last month in our example, we see that we started with our payments going less than 50% towards principal and end the loan with the same monthly payment being 99.4% principal. So the longer the duration of any loan, the more total interest you end up paying by the end, and the more heavily your early payments are weighted towards interest. The benefit to longer duration loans is that the monthly payment will be lower, which is sometimes necessary depending on your financial situation. If you already have a longer duration loan but want to avoid paying as much interest as possible, then you can choose to make larger monthly payments than what's required. As we showed in the amortization schedule, once the interest for that month has been paid, any extra amount is put towards principal, which reduces the principal balance and therefore reduces the interest charges for all future months. You can save a lot of money on unnecessary interest charges by paying off your loans as quickly as possible in this way. Let's look at an example. Say we have two people, Cheyenne and Dan, each with a $10,000 student loan at 7% interest. The only difference is that Cheyenne has a 10-year loan and Dan has a 20-year loan. Cheyenne's loan has a larger monthly payment of $116.11, and if she makes all her payments on time, by the end of the loan she will have paid $3,900 in interest plus the $10,000 principal. Dan feels pretty good about his lower $77.53 monthly payment. But by the end of his loan, if he makes all his payments on time, he will have paid $8,600 in interest plus the $10,000 in principal. If Dan decides to pay extra and makes $116.11 monthly payments like Cheyenne, he would end up paying off his 20-year duration loan in only 10 years with exactly the same amount of interest paid as Cheyenne. Now that you know how loans function, let's talk a bit about what makes student loans different from other types of loans. The first major difference is how you qualify. Most types of loans are credit-based, which means they'll look at things like your credit score, debt-to-income ratio, and duration of employment when deciding if you can qualify. This is often difficult for students to qualify for since they may not have much credit history or income. Most student loans, with the exception of Direct Plus and private loans, do not require any credit checks. Another key difference between student loans and most other loans is the timing of when you start making payments and when you start accruing interest. Most loans will begin accruing interest the first day the loan is given, and monthly loan payments start the very next month. Subsidized student loans don't begin accruing interest until you graduate, and most don't require monthly loan payments to start until 6 months after graduation. We'll review these specifics in detail by loan type when we discuss the categories of student loans and how they work. Another thing unique to student loans is the ease of pausing payments in times of financial difficulty. For most other loans, if you have a major life emergency that makes your monthly payment impossible, then your missed payments will quickly tank your credit rating and may result in the creditor taking actions like repossessing your car or your home. Federal student loans allow you to put your loans into forbearance or deferment, which will allow you to temporarily pause your payments or at least reduce them to interest only until your situation improves. We'll discuss these in detail later. Federal student loans are also unique in offering loan forgiveness programs. These programs generally offer to forgive the remainder of your loan if you've made all your payments on time for many years and have pursued certain careers like teaching or public service. The success rate for applying to these programs has historically been very low, and there are a lot of hoops to jump through and ways to lose eligibility. I'll have a video in this series dedicated to these loan forgiveness programs in detail in case that's important to you. The last major difference worth covering here is the consequence of defaulting on your student loans. Defaulting is a financial term meaning that you're more than 270 days late on your scheduled loan payments. Most student loans are secured by the federal government. That means the government is on the hook to pay your loans if you don't. Since the government makes the laws and collects taxes, they have a lot of enforcement power to collect the money you owe them. If you default on your federal student loans and don't work with the government on a rehabilitation agreement, they can garnish your wages directly, withhold tax refunds, or even issue a warrant for your arrest. Even going through Chapter 7 bankruptcy will not get rid of your unpaid student loan debt. Expect to pay back every cent of your federal student loans, no matter how bad things get. So what are the different types of student loans? The most fundamental division of student loans is between federal and private. Federal loans are provided by the Department of Education and represent 92% of current outstanding student loans. They're almost always better than private loans, and since they're provided by the government, they have lower fixed interest rates and more flexible payment plan options. Private loans can be offered by any lender, such as a bank, a credit union, or even your college. They represent the remaining 8% and are almost always more expensive with less friendly terms for borrowers. If you decide to take out student loans, you're almost always going to be better off choosing federal over private for as much of your education as they'll fund. Let's look one level deeper at federal student loans. There are many types of federal student loans out there, some of which are still available for new borrowers, and some of which have been discontinued over the years, but still have active loans being paid back by borrowers. For this video, I'll cover the 4 types available for new loans today. I'll have a future video in this series covering the details of those discontinued federal student loans, so keep an eye out for that if it applies to you. The first type is direct unsubsidized loans, which is the most widely available federal loan type. For any federal student loan, you'll need to complete the FAFSA, which is the free application for federal student aid. I'll have another video in this series on completing the FAFSA, what it means, and how to apply for federal student loans. For direct unsubsidized loans, it doesn't matter what your FAFSA says, because you don't need to demonstrate any financial need to qualify. This loan type is available to undergraduate and graduate students, though graduate students do have to pay a higher interest rate. Loan fees are slightly over 1%, which I'll explain a little later. And critically important, these loans begin to accrue interest immediately, even while you're still in school. This confuses and surprises a lot of people, so let's look at an example. Let's say you take out a $10,000 direct unsubsidized loan in 2023 at 5% interest, and you plan to graduate in 4 years with your bachelor's degree. That $10,000 loan accrues $500 of interest every year for 4 years while you're in school, meaning you already owe $12,000 at the time you graduate. After you graduate, you're given a 6-month grace period, which is just a period of time where they don't yet require that you start making monthly payments. This 6-month grace period adds another 6 months worth of interest, in this case $250 to your debt. At the end of this grace period, if you haven't paid off the $2,250 in accrued interest, then it will be capitalized. Capitalization is a process of taking interest that's owed and rolling it into your loan principal balance, effectively growing your student loan balance. So why does that matter? If you recall from our amortization schedule example, your monthly interest is calculated by multiplying the monthly interest rate by the principal balance. So if you have a $10,000 principal balance and owe $2,250 in interest, at a monthly interest rate of 0.5833%, the next month you'll owe $58.33 in new interest. But if that $2,250 of interest was capitalized, your principal balance now becomes $12,250, and the next month you'll owe $71.45 in new interest instead. Capitalization is essentially working backwards, moving you further and further away from actually paying off your student loans. If you have a direct, unsubsidized loan, the only way to avoid capitalization is to pay that $2,250 in interest before the end of your grace period. That could mean paying a small amount every month while in school, or making a single large payment after you graduate during the grace period. Let's bring back Cheyenne and Dan to take a quick detour to demonstrate the financial impact of this capitalization using an example loan. Both took out $10,000 of direct unsubsidized loans. Let's change their interest rate to 5% to match our example above, and say they both had a 10-year duration. Dan paid off his $2,250 in interest after graduating before the grace period was over. That means for the rest of the loan period, his monthly payment is $106.07, and he ends up paying $4,978 in interest by the time his loan is done. Cheyenne didn't know about capitalization, so her interest got rolled into her principal balance at the end of her grace period. That means for the rest of the loan period, her monthly payment will be $129.93, and she ends up paying $5,592 in interest by the time her loan is done. So capitalization costs her an extra $614, which is 12.3% more interest than Dan paid. If you increase the loan amount, the interest rate, or the loan duration, the cost of capitalization just keeps going up. All right, now that we understand capitalization, let's talk about the second federal loan type, direct subsidized loans. This loan type is only available to students who demonstrate sufficient financial need through the completion of the FAFSA and are pursuing an undergraduate program. Unfortunately, graduate students are not eligible for this loan type. Subsidized means that the government pays the interest you accrue while you're enrolled in school, during a grace period, and during periods of deferment. That means there won't be any capitalization because the government pays that interest for you. These are the best type of loans out there. Loan fees are slightly over 1%, and finally you get the same 6-month grace period. The third type of federal student loans are direct plus loans. There are actually two subtypes of direct plus loans that are very slightly different: grad plus loans and parent plus loans. Neither requires you to demonstrate that you have financial need. Both have large loan fees at about 4.2%. Both are unsubsidized loans and therefore will have their interest capitalized if you don't pay it off before the end of the grace period. Both have higher interest rates than the other federal student loan options, and both require credit checks for the borrowers. This credit check is different than the typical credit-based evaluation done by institutions giving private loans. The Department of Education is looking for what they call adverse credit history, which is basically a pass-fail evaluation. There are 8 things they look for, and if the borrower has any of these things in their credit report, then they will not be able to qualify for a direct plus loan. I've put the list here on screen, but I won't talk through each one. So let's talk about the differences between these two subtypes. The first difference is who the borrower is. Logically, the grad plus loan is taken out by the student, while the parent plus loan is taken out by the parent of a student. Another difference is that grad plus is for graduate degree seekers and parent plus is just for undergraduates. In order to qualify for the parent plus loan, the student must be claimed on the parent's taxes as a dependent. The last difference is in the grace period. A grad plus loan has a built-in 6-month grace period, where a parent plus loan has no built-in grace period. You'll actually need to request a parent plus borrower deferment while applying for the loan in order to get a 6-month grace period added. The final type of federal student loan is called direct consolidation loans. These loans are different from other types in that they're just a way to combine multiple existing federal loans into a single loan with a single interest rate and a single monthly payment. This is sometimes done by borrowers once they graduate to simplify their paperwork. This sounds like refinancing, which is a way of renewing other types of loans like mortgages with new interest rates and new payment terms, but that is not the case. A direct consolidation loan will not lower your interest rate. They'll simply take a weighted average of the rates on the federal student loans you already have, so your total monthly payment will remain the same. This consolidation can also cause you to lose benefits unique to certain types of loans and can cause you to lose progress towards a loan forgiveness program. Just be very careful to research the consequences to your unique circumstances before you decide to pursue a consolidation loan. Now that you know the 4 major types of federal student loans, let's talk about some of the restrictions. A common question is, how much can I borrow? Which is dependent on a number of factors. The government has annual loan limits, which limit how much you can receive in federal loans for any single year, and aggregate loan limits, which limit the total amount you can borrow from the government for undergraduate and graduate studies in total. Let's start with annual loan limits for undergraduates. The first factor is whether you're a dependent or independent. Essentially, this comes down to whether you're financially supporting yourself or relying on someone else, usually a parent. The vast majority of people coming out of high school into university will be dependents, while degree seekers later in life who already have jobs and careers will be independent. Technically, this comes down to if you're claimed as a dependent on someone else's annual income taxes. Just ask your parent or guardian if you're unsure of your status. The next factor is what year you are in your undergraduate studies. As you progress through your degree program, the government will allow you to borrow larger amounts of money each year. They break down these limits across 3 categories: first year, second year, and third year and beyond. Here you can see the annual loan limits for undergraduate studies in the table. So what about limits for graduate studies? Graduate studies are significantly simpler since they consider all applicants to be independent regardless of their tax status and ignore what year of study you're in. The federal annual loan limit for graduate studies is a flat $20,500. To further complicate this picture, the federal government has limits on how much of your annual loans can be subsidized. Recall that the government pays your interest while you're in school for subsidized loans and helps you avoid capitalization. Since these loans are so highly sought after, they have lower annual loan limits for subsidized loans. I've added the annual loan limits for subsidized loans in parentheses on the chart so that you can see them. Note that the graduate students are only allowed unsubsidized loans, which is why there's a 0 in parentheses there. I've added a video chapter titled Annual Loan Limits for this chart so you can quickly find it in the future if you need to reference it. Alright, now let's talk about aggregate loan limits, which is the total amount you're allowed to borrow from the federal government regardless of how long your education takes to complete. The same splits between dependent versus independent and undergraduate versus graduate exists, as you can see here. If you wish to borrow money beyond your aggregate loan limit, you'll need to seek private loan sources. Be aware that the aggregate loan limit for graduate studies includes any federal loans that you already have for undergraduate studies. Similar to annual loan limits, the aggregate loan limits also have a limit for how much can be subsidized. I've added the aggregate loan limits for subsidized loans in parentheses on this chart and added a video chapter for future reference. Another element of federal loans that surprises some students is the loan fees. As we saw earlier, these fees are about 1% for direct subsidized and direct unsubsidized loans, and a whopping 4.2% for direct plus loans. These fees are taken directly out of your funds each time you receive a disbursement. Disbursement is a financial term for when loans are actually deposited into your school account each semester. If you're expecting a $1,000 disbursement from a federal loan for the fall semester, you'll actually receive something between $950 and $990 due to the loan fee being subtracted. These fees are unique to federal student loans, as private loans rarely have loan fees. Another term you'll see when researching your federal loan details is a reference to your loan servicer. The U.S. Department of Education outsources the administration of federal student loans to private companies. These companies work on behalf of the U.S. Department of Education to collect loan payments, respond to questions about loans, and keep records of all payments and outstanding balances. When you think of your student loans, the loan servicer is likely the name you'll recognize the most since you register on their website and manage your loan payments through them. Here's a list of the major loan servicers currently used by the U.S. Department of Education. You'll always be interfacing with a loan servicer rather than the federal government themselves when doing anything with your loan. Another huge benefit to federal student loans are the options for deferment or forbearance. These are both programs that will allow you to stop making loan payments for a period of time if you experience financial hardship. Let's start with deferment. In order to request a deferment, you'll need to fill out a form with your loan servicer explaining your situation. There are a variety of circumstances that may qualify you for a deferment. I'll go into eligibility requirements for each of these in more detail in another video. But the general categories of deferment are cancer treatment, economic hardship, graduate school, in-school, military service, parent plus borrower, rehabilitation training, and unemployment. It's important to be aware that interest may continue to build up while your loan is in deferment, depending on the type of federal loan you have. Subsidized loans will not accrue new interest while in deferment, while unsubsidized and direct plus loans will continue to rack up interest charges. Deferment periods work just like grace periods in that any interest that has accrued by the end of the deferment period will be capitalized as soon as the deferment period ends. Fortunately, you can choose to pay the interest that builds up during these deferment periods to avoid this nasty capitalization. Functionally, forbearance is very similar to deferment, but can only be granted for periods of 12 months or less. If you reach the end of your forbearance and the circumstances preventing you from making payments are still ongoing, you'll need to apply for another forbearance period. Be aware that applying for a new forbearance period is not extending the current forbearance period, which means capitalization will be triggered on any unpaid interest when the original forbearance period ends. In order to request a forbearance, you'll need to fill out a form with your loan servicer explaining your situation. You'll need to decide whether to apply for a mandatory forbearance or a general forbearance. A mandatory forbearance has strict eligibility requirements similar to a deferment, but cannot be declined by your loan servicer if you qualify. The categories of mandatory forbearance are AmeriCorps, Department of Defense Student Loan Repayment Program, medical internship or dental residency, National Guard duty, student loan debt burden, and teacher loan forgiveness. I'll go into eligibility requirements for each of these in more detail in another video. A general forbearance has no special eligibility requirements, but is just asking your loan service provider if they'll allow you to stop making payments for a period of time. This decision is entirely up to your loan servicer, but is an option if you don't qualify for any mandatory forbearance or deferment types. The better your payment history and explanation of your situation, the more likely they'll be to approve this. Unlike deferment, in forbearance, both unsubsidized and subsidized loans will continue to accrue interest, which will be capitalized when forbearance ends. This makes forbearance especially dangerous because it's easier to get than deferment, and most people don't understand that it can grow their student debt burden through capitalization. If you choose to go into forbearance, make every effort to continue paying the interest that accrues every month. If you're having trouble repaying your federal student loans over an extended period of time, an income-driven repayment plan is probably a better option than deferment or forbearance. I'll talk about these payment plans shortly. But first, a quick clarification about administrative forbearance during the COVID era. In March 2020, U.S. lawmakers passed the CARES Act, which, among many other things, stipulated that no payments would be required on federal student loans and interest rates would be set to 0% for a period of 6 months. This was a very unique application of forbearance at a national level that carried no capitalization risk and has been extended multiple times. It remains to be seen how long this relief will continue to be extended, but I wanted to specifically mention it since it's functionally very different than applying for an individual forbearance period, which is what I've been discussing so far. That brings me to the last major benefit of federal student loans: diverse repayment plans. When you first begin making payments on your federal student loans, you'll probably be defaulted into the standard repayment plan. What many borrowers don't know is that there are many different payment plans available, and you're allowed to switch your payment plan anytime for free. I'll have an entire video dedicated to the different payment plans and how they work. For now, just know that they have plans with monthly payments that grow over time, extended timeline plans for those with very large student loans, plans with payments based on a percentage of your income, and plans for those working towards loan forgiveness programs. The U.S. Department of Education wants you to be able to repay your loans, so they've built a lot of payment plan options to make that more feasible. If you find yourself way behind with missed payments and in default, they also offer loan rehabilitation that can get you back on track. I'll have a separate video on loan rehabilitation and what you can do if you're way behind on your federal student loan payments. If you've reached the annual or aggregate limits of the federal student loans you can qualify for and need more financial assistance, then you'll need to consider private loans. Private loans are any student loan that's offered by an institution other than the federal government. The first thing to know about private student loans is that everyone is different, since all the terms and conditions are set by the institution providing the loan. That means you'll have to look a lot more closely at each private loan to understand how it works and try to compare it with your other options. Let's talk about some of the ways private student loans tend to differ from federal student loans. First is that private student loans are almost always credit-based. That means they'll run a credit check and examine your payment history, credit score, and ability to repay the loan. They'll also almost always require a co-signer, since most students do not yet have the credit history or income to qualify on their own. A co-signer is someone else, usually a parent, who signs on the loan and agrees to pay it back if you don't. If you miss your payments, you'll be hurting not only your credit score, but also the co-signer's credit score. So consider carefully before entering this kind of agreement. Another difference is interest rates. Unlike federal loans, which have statute-set interest rates that apply to everyone, private loans will have higher interest rates for those with low credit scores and lower interest rates for those with good credit scores. In most cases, if your co-signer's credit score is not in the good to excellent range, then you'll have a hard time qualifying for a private student loan at all. If you want to learn more about credit scores or how to improve them, I've linked my video on the topic above. Federal loans are all fixed interest rate loans, which means your interest rate and monthly payments don't change. Private loans can be fixed interest rates, but many of them are variable interest rate loans. Variable interest rate means your interest rate and monthly payment will fluctuate over time based on market interest rates. Variable interest rates are dangerous since there's no cap on how high your monthly payment could go. It's very difficult to budget your expenses when you have no way to predict your monthly student loan payments. I personally recommend avoiding any loan that has a variable interest rate. If you already have one, then I would work on paying it off as quickly as possible or refinancing it into a fixed rate loan. Private student loans also don't benefit from any of the public service or teacher loan forgiveness programs offered by federal loans. Private loans also rarely have an option for deferment or forbearance or alternative payment plans. There are, however, a few circumstances where private loans could benefit you. First, they usually allow higher borrowing caps than federal loans, so if you need more than you can get from federal loans, then private loans may be an option. Second, if your co-signer has excellent credit, then private loans could be cheaper than Direct Plus loans due to the 4.2% loan fee charged on those federal loans. Third, they're available to part-time students, while federal loans require you to be enrolled at least half-time. And finally, most international students would not qualify for a federal loan to attend university in the US, which means private loans are their only option. That was a lot. If you've stuck it out all the way through this video, then you now know more about student loans than 99% of the population. At the very least, you have a good understanding of what student loans are, how they work, and what options are available. There will be several more videos in this series as we dig into some of these areas in more detail. If you have an area you still have questions about, let me know in the comments. See you next time.